So let's bring in here Stephen Miller, fixed interest expert and an advisor to GSFM Funds Management. Stephen, I want to take up the Treasurer there on his comment. He's right to say that we don't have an inflation problem today because of wages. The problem is in the future if wages do start to rise, and therefore, as a result, the Reserve Bank Governor has already warned, if you start to get wages inflation, we'll keep raising interest rates.
I think that's exactly right. What we've seen in inflation for 2022 so far does, as the Treasurer said, doesn't reflect what's gone on in wages growth. But tomorrow we're going to get those GDP numbers, and I'm thinking they're going to show a surprising acceleration in wage inflation, and that might mean that rather than inflation come down as the Reserve Bank expects through 23 and 24, it might sort of be a little bit more sticky, a little bit more stubborn, the kind of sort of inflation inertia that we saw in the late 70s and early 80s. And I think that's the danger with taking, a more relaxed approach to wage growth now, that we do see wage acceleration. The Reserve Bank will have to respond to that wage acceleration through 2023.
So you can see this rate rise here, but you get a sense, though, some in the market were anticipating maybe after this rate rise, the Reserve Bank would back off because we had two of our major banks, their chief economists, saying that the cash rate would peak here at 3.1%. But what the Reserve Bank says today, no, it's going to keep on going.
No, and
so the NAB, the ANZ, that says it's going to peak out at 3.85%, may be closer to the mark.
I think something closer to 3.85% is close to the mark because we will get an acceleration in wages growth, as we would naturally expect when we've got an unemployment rate that's close to a 50-year low.
Yes.
And as I say, that will be revealed in those numbers tomorrow. I think the other point here is that there's sort of this Australian exceptionalism that sort of says we've got a different set of circumstances here. They're not that different. Our core inflation rate is not that different from the US, from Canada, from New Zealand, from the UK, from even from Germany on as I say, our core inflation rates. So there's sort of a question mark as to why our policy rate is so much lower than, say, the US, which, as we heard, might be 5% by the end of January. It's 4.5% now. The Bank of Canada, likely 4.25% by the end of the year. Reserve Bank of New Zealand already at 4.25%. Even that laggard, the Bank of England, is likely to be at 3.5%. So it sort of does look to be a little bit anachronistic that Australia's rate is so low compared to those other countries when it looks as though wage growth and core inflation pressures aren't that different from what's happening elsewhere.
So the funny thing about this was, and you can see here US interest rates where they've gone to 4% already, as Ed says they could be at 5% by February in the Reserve Bank next meets. But the one thing about this is as the US rates rise and ours remain relatively flat, the dollar popped today above 67 US cents. But truth be known, if that happens and those US rate rises keep going, our dollar's going to tank at some stage.
No, exactly. The wider the interest rate differential, the weaker the dollar will be, and that in and of itself leads to inflation pressure because the price of imported goods goes up. So, the Reserve Bank's got to be a little bit careful here. Yes, I think we've remarked in the past, it's talk the talk on inflation. I'm still not convinced it's walking the walk.
So I want to take you to this. Clearly that shows with the pop in the dollar today above 67.2, that shows that some in the market really thought in their own heart that the Reserve Bank might back off today.
No, I think some in the market did think the Reserve Bank might back off today. There was sort of some talk about maybe a 15 basis point increase rather than a 25. I do think that, as the RBA said today, it does expect to raise rates further. I think there's at least two more, so that takes it to 3.6. And I suspect that if you're a betting man, you'd want to bet on more after that. Given what we're now seeing in wages and given, the resilience in the economy, we're likely to see also with the growth numbers tomorrow.
OK, so the US, New Zealand, the UK, Europe are all talking about recession. Here, there's no talk of recession. It's not going to happen. But what you're painting right now with ongoing rate rises increases the risk of a sharper economic slowdown when eventually consumer spending hits the wall, when these interest rate rises do catch up with the business community as well. And maybe at that point, you start to see an increasing joblessness in our economy, which the government has forecast in the budget.
Yeah, true. We may see an increase in joblessness in the economy. We may see an increase in joblessness in the US. Some would argue that we do need to see some sort of backup in the unemployment rate because we're probably at full employment already, and we need to sort of take this inflation pressure out of the economy, and that necessarily involves some increase in the inflation rate. Hopefully temporary and hopefully not too much. The risk might be that in trying to keep or having too strong a focus on unemployment, that the RBA doesn't tighten enough, and then the inflation genie gets out of the bottle and they've got to slam the brakes on and take rates actually ultimately higher than they would have otherwise.
And that's the great danger, really, for the economy, isn't it? And potentially even for the economic downturn in the future Australia might see.
That's true. Because this is the lesson from, again, the late 70s, early 80s, that if you prevaricate in aggressively tackling inflation, you have to slam the brakes on a la Paul Volcker in 1980. And that leads to a bigger and more substantial macroeconomic dislocation in terms of growth and unemployment. No one's like seeing unemployment go up. Now, it's got to go up. What we want to do is minimise the increase in unemployment so we can get that inflation out of the system.
Stephen Miller, good to have you on the program today.